Hello, everyone. Welcome to the video. I'm sorry it's been a while. I'm going to try to upload these off and on if I can. My wife's currently out of the room, so I have some time to make a video today. We're going to be going over Newport Exploration Ltd. Limited. This is a oil and gas slash mining company that has royalties in the, I believe it's called the Great Bastion, that has companies with Beach and Santos that both run it, and they get a 2.5% gross royalty from it. Now, this company pays a 15.79% yield. However, it's really not good, and we're going to show you why. Now, you might be thinking, being like, damn, even if I wait like 5 years, that's almost 100% return if I just reinvest the dividends. And you would be right, but this company might not be around for 5 years, and we're going to go over its financials. So, like normal, if you go over any company, you want to look up the company, find their website, right here. Look at that, Newport Exploration. Woo! We found it. And once it finally loads, right here, enhances shareholder value through our 2.5% gross overriding royalty on oil and gas permits in the Copper Basin in Queensland, Australia, and through 100% interest in the Choo Chua Copper Gold Project in British Columbia, Canada. Sounds really good, right? This is an oil, gas, mineral company. It has it all. It has everything you're looking for. On top of that, massive dividend. But like every single stock company you ever buy, you need to research this. So, financial statements. We have it right here. Let's go for their financial. So this is July to July because we're still waiting on the October one, which is not out yet. Spoiler, I already looked through this and it's just as bad as I thought it would be. So we start up here. So it's July 31st of 2022 compared to July 31st of 2021. See if they say anything scary. Of concerning basis and accounting and base of audit. The may cast significant doubt on the equity's ability to continue as a going concern. If we conclude that a material uncertainty exists, we're required to draw attention. Our conclusion are based on the audit. Future events and conditions. So I'm just trying to see if they say anything that's like a massive, like, oh my God. I don't think they do, though. No, they don't. So let's go over this. Okay, so here's its current assets as of July to July. You can see right down there. Cash and cash equivalents is 728,000. Compared to last year, it was $2.8 million. Receivables, it's down. Prepaid expenses, they prepaid quite a bit. And their short-term investments, which, spoiler, look down below, are bonds or basically anything from Canadian banking institutes that are 90 days plus locked in, are 90 days, or are short-term investments, sorry. Now you're looking at this and you say, they're missing $2.1 million of cash. And these have not grown by 2.1 million. And I'm going to show you where that money went. Equipment, look at that. Down, you like to see it. Right of use assets. This is note 7. We're going to go back to this one because I have no idea what the hell it is. Exploration and evaluation asset is just, it's always one because I think they have to put at least something in here. Look at that difference. $2 million just gone from the assets. What the hell? Current liability. Look at this. It's way up to the last year. Not way up, but you know. Current portion of lease activity. Look at that. This now has $60,000. This had nothing. Income tax payable. Look at that. Basically break even. Income tax is down, which is, you know, scary because that normally means their cash is down. Current liabilities. Look at this, guys. 666,606 compared to $532,000. And we're just going to ignore that. So this is now where you need to pay attention if this is a stock you are buying. And I mean you need to pay attention. Look at the expenses. This shows you everything you need. Amortization is up. Amortization of right of use asset is up. Consulting fee, yeah, it's down just a little bit. Director fee, look how much that's increased. It's increased by 5,000. Again, not bad, but it's gone up. Exploration expense is down. Foreign exchange, loss or gain. This is a loss. So they lost 97,000 last year and only 43,000 this year. And it basically goes down and down and down and down and down. Now, it basically total loss from operation 1.5 mil compared to 1.6 mil last year. Good. Look at that. That's fantastic. Now, here's their income. Interest income went from 57,000 to 32. Their petroleum royalty went from 10 million to 9.2 million. Where the hell did 1.3 million go? Well, they just didn't make it. That's simple, because you're going off royalty and you're hoping it does very well. Income, net income before income tax, significantly down by guess what? Almost 2 mil. Actually, that's a $2.6 million loss right there. And, you know, hey, we have the income tax, expense, etc. Now we're down to 5.2 mil compared to 6.2 mil from last time. Basic diluted 0.5 to 0.6. The dividend they paid this time was, I believe, around 7 or 8 cents a share. Right off the bat, earnings per share doesn't cover the dividend. But let's continue going down. Here's the cash flow. 5.2 mil compared to 6.2 mil. Again, I'm going to move myself. I'm actually going to shrink myself a bit. There we go. Just so you guys can see this. Now look at all this. Income taxes paid. And so we break down and everything. This is basically a breakdown of, hey, here's where all the money is, et cetera, et cetera, et cetera. Interest received, they added on. And look at this. Not bad. It's basically the same as last year. Now, investment redemptions, purchases, net. So, you know, they basically purchased investment redemptions, okay? Cash provided used in investing activities. Right there. There you go. Dividends. Now, this is the biggest one. 7.39 million. 7.37 mil. And then repayment of lease liability. Cash used in financing, $7.4 million compared to 7.08 mil. Look at this decrease in cash. You know how we said, hey, there's 2.1 million missing? We found it. They lost it. They didn't have the cash to do it. Look at last year, same thing. They didn't have the cash to cover either, so they still lost money. Now, let's see what the payout ratio is. This is all of its net cash divided, this is the dividend divided by its total net cash. I'm sorry, I'm going to make this quick because I think my wife's coming back from going out and I want to go say hi to her. So let's do this. Let's do this the actual way. So we're also going to take the repayment of lease liability in. Why? Because it's an expense tied into the financing activities. Which, no, we could make this worse, but we're going to be nice on it. The 7,424,600 divided by, now this is their net cash provided by operating activities. This is the only thing they're cash positive in. Everything else is a negative. 5,460,431. Your payout ratio times 100 is 135.97%. That is not sustainable, guys. On top of that, look at this cash. Cash beginning of the year. This is July to July this year. They started the year 2.8 mil. They're at 728,000. Why do you think now, if we go into their dividend history, why do you think they're cutting the dividends so much? They're cutting, trying to raise, cut it again, because no one's buying into this BS. They're unstable. And the people that are in this company, you need to look in their financial statements because their price broke a very important barrier. Look at this. 5 years ago, in 2017, we were 24 cents a share. We are all the way back to November, December of 2019 levels. And year to date, we lost our 48.50 cent level, and now we're just down. So yes, you could buy this, but you're banking on this cash to go right back up so they can pay you a dividend. Because if it doesn't go up by 2.1 mil, they can't pay you the dividend. They're going to have to go into debt. And again, this company constantly brags all the time. We have no debt. We're a fantastic investment. We have mining, oil. We have mining, oil, and gas. But if you can't sustain it, that doesn't matter. And that's what people, they see this guy, they're like, hey, he has zero debt, they're fantastic. But if you look at a financial statement, you're like, oh my God, they're losing cash hand over fist every single year. That no debt isn't going to help them. Yeah, it'll help them for now, but guess what's going to happen in 5 years when they don't have the cash or income to sustain the dividend? Massive div cut or no dividend whatsoever. And very likely, if they do keep it, they're going in debt. They won't go into much for the first year, second year, third year. It's going to keep piling up. They have to do something about this. So, to answer the Facebook guy who told me, well, you should do your research, I just did it. I want you to tell me I'm wrong. I just showed you their financial statements. Tell me I'm wrong, buddy. Now, again, this is also just to inform people like the most basic single stock stuff to look for in a payout ratio is free cash flow minus expenses minus dividend divided by its norm. Well, how I do it, free cash flow or funds from operation, or AFFO basically is the easiest way, but free cash flow, subtract expenses, and then you basically take the dividend and divide it by that total, which I didn't do for Newport because I want to be nice to this guy because this guy really was hammering home this is the safest investment you can make. And I wanted to be like, you know what? I'm gonna go nice on you because I want to show you how bad it actually is. Now, 35% 1 year isn't bad, but this has continued for years. So let's go back to Newport. So again, remember their cash on hand as of right now is $700,000. Let's go back 2 years and check how they did. So let's go all the way back to fiscal year 2021. We're going to go to the very end of the year. Keep scrolling down. Look at that. 2020, they had, again, a huge amount of cash reserve. And look what happened. We lost 1.9 mil. Okay, let's see. Where did it go, everybody? I wonder where. Look at that. 1.9 mil. Increase in cash and equivalents during the year, negative. Their only positive year was 2020. This is 2019 to 2020. In the 2 years, this is with oil going insane, going high, really going very high. They have yet to turn a profit since 2020. So again, I bring the question up of how is this company that doesn't pay debt, how is it safe? I really want someone to tell me this company is good for me. If you want a good, cheap company, this one is the exact same price. It pays a monthly dividend, payout ratio of 30%. There is so much room for this guy. It's not even funny. On top of that, they did also hike the dividend this year. So let's see what it is. Gonna have this guy over here. Now, below me, we have what they pay in. So we're gonna do this. So they pay this much on a monthly basis in Great British pounds, and then they convert it. You don't get a withholding tax. They convert it and suck it up. And it's 0.0022 Canadian. Hey, guess what? That's not a lot. So let's add it all up and let's see what type of yield we get. So 0.0022 times 12, because it's 12 months in a year. 0.0264 annual dividends based off the current Great British Pound to Canadian, all that stuff. That divided by the current price gives you a yield of, drumroll please, 7.04%. Is this as much as, any NWX? God, no, it's not even close to that. But its payout ratio is 30% compared to 130%. And this comes from a company that has had negative cash now for 2 consecutive years. Again, I would love for you to tell me I'm wrong, but I'm not because I just showed you everything. Now, I'm sorry if I come off as a bit of a prick in this one. This is more because the guy was giving me very, I'm not going to show him. I'd love to, but I'm not going to because I don't want people to go after him. Literally telling me, hey, what you're talking about makes no sense. You know, they're all this different stuff. They're fantastic. They have zero debt. They're so safe. They can't have a 190% payout ratio. No, that was last year when I checked, and it's 135 still. And their cash has depleted to only 700,000. Did they get better? Yes, I was completely wrong. They got better by 60%. But you're not correct by any means at all. I'm way closer, buddy. They're 130, they're paying 35% extra cash than they have. Where are they taking that from? Oh, they're taking that from their treasury slash cash reserve, which, surprise, has now depleted to only 700,000. At the end of next year, if they do not take out their, what I'm assuming are bonds in like the 2.8 mil of their treasury or whatever in their investment and stuff, they're legit going to have to go into debt, or they're just going to be like, yeah, we're just going to cut the dividend because we can't sustain it. I just gave you your answer, dude. It's not safe. I do not recommend anyone invest in Newport Exploration because they're unstable. And I just showed you this 15% yield is a complete farce. Because again, look at the dividend. Cut, hike, cut, cut. This one, I guarantee you, is going to be a cut. Or if it is a hike, the next one's going to be cut. And they'll go cut, hike, cut, hike, cut, hike. But we'll have to see. Or they might go right back to where they were before. Because guess what happened in 2020? They only paid a cent and they were profitable. This is all not profitable. Ever since then, these 2-cent dividends they can't afford. They literally just can't afford it. So that is the video, guys. I'm sorry. I'm sorry I acted like a prick, and I was like, hey, I'm gonna treat you guys like kids. This is not good. I'm gonna drill it into your head. But that is the whole point of this. We look at high yielding stocks that myself and lots of people love and see if they're actually sustainable. But you can't go from something like an ETF, like HYLD, which is paying 14%. Of course, it's not going to load the actual yield, paying 14% right now. And you compare this, which holds, QYLD, RYLD, XYLD, JEPI, and 2 Canadian income-focused ETFs that clearly makes enough money from the conversion rate alone. You can't compare this to a single stock. That's not how it works. Single stocks are much more risky, and you have to at least find the payout ratio. Why doesn't NWX show the payout ratio? Simple. It make everyone run away with fear. So that's it, guys. I hope you enjoyed. Have a good night, and I will see you guys next time. We're going over HYLD or a different high-yielding CEF ETF because they're a lot harder to find. However, I also really love picking in them and seeing what they have. That's it, everyone. See ya. To the guy that told me NWX was safe, it's not. And again, I just proved it for you. Bye.